Hey everyone, and welcome to this explainer of Humphrey Yang's Ultimate 2025/2026 Stock Market Guide. If you've ever felt like Wall Street is speaking a completely different language, or that investing is some exclusive club you just don't have the password for, you are in exactly the right place. Today we're going to build your foundational investing knowledge from the absolute ground up. We're taking all those complex financial concepts and turning them into a clear, actionable blueprint for your wealth.
But before we start pouring that foundation, we really have to ask the most urgent question facing your money right now. This is going to show you why investing isn't just optional, it's mandatory. Is inflation quietly eating your savings? Think about it. If your money is just chilling in a regular bank account, or worse, stuffed under a mattress, its purchasing power is slowly shrinking every single day as the cost of groceries, housing, and gas goes up. Literally doing nothing with your money basically guarantees a loss over time.
All right, so here is our step-by-step roadmap for today. We'll be covering the power of investing, key market terminology, approaches and accounts, how to research stocks, constructing your portfolio, and finally, navigating taxes.
Okay, let's jump right into part one, the power of investing and how we're defeating that inflation monster.
So, what is your ultimate defense against inflation over the long haul? It's combining the S&P 500 with the absolute magic of compound interest. Now, the S&P 500 is essentially just a scorecard of the 500 largest publicly traded companies in the U.S. And historically, it's returned an average of around 7 to 10% per year after inflation. When you combine that reliable historical growth with compound interest, which is just your money making money, and then those returns making even more money, you create this unstoppable financial snowball. This is exactly why getting started early, even with just a tiny amount of cash, is the absolute biggest advantage you have.
Moving right along to section 2, key market terminology, or the vocabulary of wealth.
Let's tackle the big animals in the room first, so you never panic when the news cycle turns negative. You've probably heard of bull and bear markets. Well, think of a bull thrusting its horns upward into the air. That's a market that's growing and thriving. Now picture a bear swiping its paws downward. That signifies a market dropping, usually by 20% or more. Understanding that bear markets are a completely normal, temporary part of the economic cycle is what stops you from panic selling your hard-earned investments when things look a little bleak.
Next up, companies are often categorized by their market cap, which really helps you spot those massive, stable blue-chip stocks that form the bedrock of safe investing. Market cap is just simple math. You take the current stock price, multiplied by the total number of shares in existence, and boom, that's what the entire company is worth. Blue chip stocks are the absolute titans of industry. We're talking companies like Apple or Microsoft. They're financially sound, everybody knows them, and historically, they can weather major economic storms way better than smaller, riskier startups.
Now, instead of crossing your fingers and relying on the success of a single company, an index fund lets you buy an entire basket of stocks all at once. Imagine trying to find the one perfect needle in a haystack, right? It's stressful, it's incredibly risky. An index fund basically lets you just buy the whole darn haystack. By owning a tiny slice of hundreds of companies simultaneously, you're drastically lowering your risk through instant diversification. And you do it all with a single purchase.
You're also going to want to understand dividends. Think of these as little cash thank you notes that companies send you just for holding onto their stock. When a mature, established company makes a solid profit, they'll often distribute a chunk of that cash directly back to their investors. You can use that cash to pay your rent, or if you want to be a true wealth builder, you can automatically reinvest those dividends to buy even more stock, completely supercharging that compound interest snowball we were talking about earlier. All right, part 3, investment approaches and accounts. It is time to choose your tools. You really have to figure out your strategy based on your own personal risk tolerance and your time horizon. You're weighing the high-effort risk of picking individual stocks against the steady, diversified route of index funds. Picking individual stocks means doing deep research and betting on specific winners. It's thrilling, sure, and it offers potentially massive returns, but it requires active management and a stomach for high risk. Index fund investing? That's passive. It's the ultimate set-it-and-forget-it move. For most beginners aiming to build serious wealth over a 10, 20, or 30-year horizon, the passive index fund route is historically just the most reliable path to success.
Now, when deciding exactly where to store these investments, you've got standard brokerages on one hand and tax-advantaged retirement accounts like IRAs and 401ks on the other. Standard brokerages are awesome for flexibility. You can pull your money out whenever, but you're going to pay taxes on your gains. A 401k is incredible because your employer might match your contributions, which is quite literally free money. But the undisputed champion here, the Roth IRA. You put in money you've already paid taxes on, and from that point forward, it grows completely tax-free, and you can withdraw it in retirement completely tax-free. It's arguably the most powerful wealth-building tool out there for the average investor.
Section 4. How to research stocks. Let's analyze the blueprint.
When you're figuring out what to actually buy, you'll run into two main strategies: fundamental and technical analysis. Technical analysis is mostly what short-term day traders use, staring at moving averages and chart patterns to guess the next price swing. Fundamental analysis is what long-term investors do. It's like looking under the hood of a car. What are the company's earnings? How much debt are they carrying? Are their profit margins actually growing? You're trying to figure out the true, intrinsic value of the business itself.
So, when you are looking under the hood, focus on 3 key fundamental metrics: the PE ratio, the PS ratio, and free cash flow. The PE ratio, or price to earnings, tells you exactly how much you're paying for every single dollar of the company's profit. A low PE might mean the stock is a total bargain, while a sky-high one could mean it's overpriced. The PS ratio, or price to sales, is great for evaluating newer, hypergrowth companies that bring in massive revenue but maybe aren't turning a net profit quite yet. And finally, free cash flow. This is the actual hard cash left over after a company pays all its bills and operating expenses. In the investing world, cash is king, and strong free cash flow means a company can actually afford to pay those dividends, crush their debt, or invest in future growth.
Moving on to Section 5, constructing your portfolio. Time to actually build the house.
If you're a beginner, the famous 3-fund portfolio strategy takes literally all the guesswork out of asset allocation. Instead of frantically juggling 40 different investments, you just divide your portfolio into 3 core slices. First, a total U.S. stock market index fund to capture domestic growth. Second, a total international stock index fund to give you exposure to the rest of the world. And third, a total bond market fund to provide you with stability and income when the economy gets a little rough. It's elegant, it's simple, and historically, incredibly effective.
To actually execute this strategy, you're going to use modern, super user-friendly brokerage platforms, places like M1 Finance or Fidelity, to build that 3-fund portfolio. The days of having to call a guy in a suit on a landline and pay wild trading fees are completely over. Today, you can open an account on your phone in minutes, trade for 0 fees, and even buy fractional shares. That means you can start owning a piece of top-tier companies with as little as $5 or $10.
And finally, Section 6, navigating investment taxes, because it doesn't matter how much you build if you don't know how to preserve it. Okay, listen up, because holding on to your investments really matters when it comes to taxes. If you buy a stock and sell it for a profit within the exact same year, the government hits you with short-term capital gains tax. That's taxed at your ordinary income rate, which can be absolutely brutal. But if you hold that exact same investment for just 1 year and 1 day, it qualifies for long-term capital gains. Those rates are significantly lower, often 15% or sometimes even 0% depending on what you earn. The government literally rewards you financially just for being a patient, long-term investor.
You can also protect your wealth using a brilliant strategy called tax loss harvesting. This is a completely legal trick where you sell losing investments to offset the taxes you owe on your big winners. Let's say you made $1,000 on stock A, but you lost $400 on stock B. By selling stock B, you can actually use that $400 loss to reduce your taxable gains on stock A down to just $600. It's a remarkably smart way to find a silver lining in a bad trade and keep your overall tax bill as low as possible. So, the intimidation factor? Gone. The jargon is clear, and the tools are just waiting for you to use them. They say the best day to start investing was yesterday, but the second best day is today. So, with inflation continuing its upward march, what's it going to be? Will you let your savings slowly erode away, or are you ready to take that first step and start building your financial house today?